Hey guys, it's Chris Wong. For this video, I'd like to talk about the rate of return and how important it is for investing. So as a disclaimer, I'm not a financial advisor. I'm just a guy who's interested in building a portfolio. So the reason why rate of return is so important is because if you're investing in poor quality investment funds and they only get a 5% rate of return on average, whether it's through dividend yield or whether it's through the growth of the stock, the 5% annual return can be a lot different than a 10% annual return over 30 or 40 years. Let's just say, for example, I went on Get Smart About Money website and I used the compound interest calculator. So I put the scenario of investing $100 a month for 40 years and I use 5% interest and it came out to like $150,000 the total portfolio is going to be after 40 years. So the second scenario I put was 10% return, but same thing, $100 a month starting from zero for 40 years. It came out to like $632,000 after 40 years of investing. So rate of return can be a very important indicator of how well your portfolio is going to do. Now, if you can aim higher and it's safe, I would, but it's not going to be perfect. If you try to aim for a higher rate of return, you take bigger risks. So that's why they say keep it around 10% or just invest in the S&P 500 because it's around 10% rate of return on average. Now, it doesn't mean it goes 10% every single year. Some years can go down, some years can go up a lot. And it also depends on which month of the year it is, because sometimes the stock market goes down a lot and then it picks back up after. So when it comes to choosing my funds for investing, I like to choose monthly distributions and I like to choose dividend yields around 10 to 12% for my safe investments, which kind of correlate with the average rate of return of 10% for the S&P 500. And I like to make sure that the funds I invest in, they are fairly stable for the share price, with the exceptions that the share price would drop a little bit due to the indexes dropping. And that's okay if it does happen. But what I don't want to invest in is if there are funds that have a 5% dividend yield, but there's no increase in the share price. Because to me, if there's no increase in the share price and the dividend yield is 5%, then the fund only has a 5% rate of return. So if the dividend yield is considered low, then to get your rate of return has to come from the increase in the share price by holding the funds. So that when you hold your funds for a long time, you're getting an average of a 10% increase each year. So that's the share price plus the dividends. Because the investments I pick have at least a 10% dividend yield. So it's okay if the share price doesn't increase as much compared to a low yield fund, because I'm getting my rate of return through the dividends. I hope this is good information to think about when investing. If you do like the video, please give me a thumbs up. Otherwise, please subscribe to my channel for future videos. Thank you guys for watching.